Hello, how are you? Again, this is Thinktank like this, and this is the continuation of the cost object. So this is module 2B. So let's start. So what will be the topic here? So this is the continuation of the different cost object. So we started with the relevant and irrelevant cost, the controllable and non-controllable cost, the direct product and indirect product cost, the direct departmental and indirect departmental cost, the opportunity cost and imputed cost, the out-of-pocket and non-cash cost, the sunk cost and future cost, the incremental cost and marginal cost, the fixed cost and variable cost, and the last one is the committed fixed cost and discretionary cost. So, to reduce costs, we have to understand them. We have to know their nature and behavior to control them. So, let's start with the relevant and irrelevant costs. We have relevant costs. So, they are costs that are useful in making decisions. So, we have two options for the relevant costs. So, we have differential costs or future costs. So, differential is differ from one alternative to another, while future costs deals only about the future cost. And these two are part of relevant cost. Irrelevant cost are costs that will not differ on the decision on making or buying. So, controllable and non-controllable costs. So, we have controllable costs. Controllable costs are those which occurrence or non-occurrence can be influenced or decided upon by a manager. The concept of controllability is related to an organizational structure of an organization. So, example, if you are manager 1, you can control only workers 1, 2, 3 under department 1. Non-controllable costs are costs that cannot be controlled by a certain part of the organization. So, example, manager 1 cannot control workers 1, 2, 3 from department 2. So, direct product and indirect product costs. Direct product are direct materials and direct labor. So, example, you need to convert materials into finished goods. Indirect product are factory overhead. So, they are indirect product costs. Direct departmental and indirect departmental costs. So, when we say direct departmental, they are those that are directly identified with the department, process segment, or activity. So, they may be a variable or a fixed cost. Indirect departmental costs are costs that are not directly identified with a department. They are sometimes referred to as allocated costs, common costs, or plainly unavoidable costs. Opportunity and imputed costs. So, when we say opportunity costs, they are those benefits forgone or sacrificed from one alternative in favor of another alternative. Imputed costs are costs that are not incurred but are implied in a given decision. So, example, business use its own cash in buying an equipment. So, instead of borrowing from a bank with 15% interest on purchasing the equipment. Out-of-pocket costs and non-cash costs. So, when you say out-of-pocket, they are those that are incurred and are paid in cash. So, out-of-pocket costs requires cash payment. So, all costs that are paid in cash are what we know as the OPC or the out-of-pocket costs. Non-cash costs are those that are not paid in cash or a no-cash cost basis. So, sunk costs and future costs. So, sunk costs are those that have been incurred in the past and can no longer be changed. They are constant and not differential, historical, and irrelevant. Future costs are costs to be incurred in the coming period. They are relevant and of value when making decisions. They are sometimes called planned, budgeted, or estimated cost. Incremental, decremental, and marginal cost. So, an incremental cost represents a total increase in cost. while decremental costs are decrease in cost. Marginal cost is an increase in cost per unit. Fixed costs and variable costs. So when we say fixed, they are those costs that remain constant regardless of the change in the level of production and sales, but changes on a per unit basis. A variable cost are changes in total in direct proportion to changes in the level of production and sales, but is constant on a per unit basis. Committed fixed costs and discretionary fixed costs. So this is the last topic. So when we say committed fixed costs, they are those which occurrence have been committed by a business in the past by reason of contract, acquisition, or agreement. So examples are rental, interest, insurance, real estate, property tax, and salaries of production. Discretionary fixed costs, known as the engineered fixed costs. So they are costs which occurrence is assured, but the amount may change depending on the discretion or value judgment of the manager. So examples are advertising, research and development, executive training costs, salaries of guard and janitor, and repair and maintenance. So again, this is the last part of the cost object part 2. So hope you learned something from Thinktank like this. You can watch different module here on Cost Accounting and Management Accounting. Again, thank you and bye-bye.